Good morning. This is Kevin Gormley, a CPA that does financial planning from Leading Edge Financial Planning. Charlie Mattingly and I spoke this morning, and we wanted to put out a video. One of the things we try to do is communicate often, especially when there's negative events. And what's happened with Brexit is really quite a case study in investing, I should say. These types of events happen. The way we react to these types of events, and I do use the word react because yesterday the market did not price this in. Today we wake up, actually I followed until about 1 o'clock in the morning what was going on with Brexit, and it can cause a lot of emotional upheaval. It can cause bad decisions, and that's really what this is about, is making good decisions. So you see on the page here, we see some people. They're very concerned. Oh my gosh, they're look like they're watching a horror movie. We have Jamie Dimon over here, always cool and collective. The Muhammad El-Arian always comes out of the woodwork whenever there's a negative event and talks about it. Bill Gross is always talking panic. So what we see is a lot of red, a lot of people that are concerned, and this immediately turns on the part of our brain that makes us say, should we be worried? Your Money, Your Brain from Jason Zweig. Immediately it turns on the part of our brain that causes fear. And what Jason Zweig says, it doesn't matter who you are. If you're a human and you pay attention, the frontal lobes are really where we do our critical thinking. Deep inside our brain is the reptilian part of our brain. In less than a split second, emotion floods into that part of our brain and causes fear, and we can't help it. And there's many other books that have been written. This is Behavioral Finance 101. So this video is an attempt to say, yes, the market's down big today, but how should we think about this as investors? So I'm going to pause the video, go to the first slide. So what happens being an investor is that yesterday the market seems very safe, and today the market seems like a dangerous place. And when I say the market, stock market. And this happens because every time when the market's just going up, everything feels good. There's an event, and like I said, in a split second, things not only feel more dangerous, but in our mind, and the news media does a great job with this, so I recommend you don't watch TV. But in our mind, they say, well, what if this happens? What if, and so people have been linking Brexit all the way to World War III. Now, do we know if markets are going to go up or down in the next 3 to 6 months? Charlie and I have always advocated that we don't know. We are agnostic, short-term, long-term. Being an investor, we get positive returns, or at least we have appeared to get positive returns on our investments over very long periods of time. But short-term, we don't know what's going to happen. We always need to be prepared for these types of shocks to the system. We just need to be prepared. So I look back in just my lifetime, all the events that have happened. In the 80s, we had the Arab oil embargo. I do remember as a child sitting in lines waiting for gasoline. The S&P was down 43% at that time. If you sold out, you would have not gotten the returns. Business Week came out with the death of equities. Gold hits record highs, massive inflation. Then when I was a junior in college, Dow drops 23% on Black Monday. Now 500 points today is not like 500 points back in '87. And so, again, people panicked. I know people jumped out of windows because of what happened there. But again, a few short years later, everything was fine. We've had 2 times when Iraq has been invaded. We've had a dot-com crash, Y2K. We were afraid of our computers. We were afraid of the market, sub-market crisis. We did have a market crash. It was 55% in 2008 and 9. Again, if you would have sold out then, you would have not gotten the recovery over the next number of years. So the point of this is that there's always been these exogenous events that have happened. And yeah, at times markets do crash, but, and Charlie mentioned this to me this morning, that we put together financial plans expecting there to be massive volatility. And we don't mind volatility when it's up, but we do mind when the volatility is down. But we put together financial plans, we do investment policies, knowing that part of your portfolio could be down at times. So if you are an accumulator right now, again, if you're an accumulator and you're buying consistently, these times when markets go down are opportunities. So for most of our client base, there's opportunity if markets go down. Now, for the people that are retired, it's a different story. And so that's why we believe in the 3-bucket approach, and we'll be coming out with an article and a video on that in the next week that says take short-term money and use it for your short-term goals, mid-term money for your mid-term goals, and then stock and other types of longer-term investments, use them for 7 to 10 years in the future. So even for retirees, these types of exogenous events should not really affect our lives that much. But again, all the fear mongering we see on our phone in real time, things happening, and it can cause fear. What I would suggest we do, as they suggest in Misbehaving from Richard Thaler, is to slow down our thinking and to not allow the part of our brain that causes, oh my gosh, to take hold. As long as your personal financial situation has not changed, any exogenous events in the world that happen and will continue to happen, the next 10 years, we are going to have at least 10 of these types of things again. These things are going to happen. It's the price we pay to be stock investors, but that's how you get the great returns. So let me show you another perspective on investing in emotion. So this is a video on Brexit, and yet I'm hardly talking about Britain, and I understand that, but I will get to it, I promise you. This is all about slowing down our thinking, okay? From the years 1994 to 2014, 1995, I'm sorry, to 2014, equities had a return of 9.9%. Bonds 6.2, gold 5.8. This was 2014, so oil was still up. International stocks and homes were up 3.1%. So all of these asset classes were up tremendously, yet the average investor was up 2.5%. So the average investor did not do as well with returns as their investments did. The investments, the actual investments, the stocks that people own, the bonds that people own, did much better than what the average investor received, and this is all because of fear. So this is actually the returns during this time period, 1994 to 2014. And what we see here is if you had $100,000 invested today, we're in end of 2014, and the market's still higher than it was then, you would have $650,000 some dollars by investing in equities. But you would have also had to go through 2 periods of pain. It looks like, we've had the twin peaks and now the third peak. And we had to go through these periods of pain. This is the price we pay to get these really high returns. But this also happened in bond markets. It also happened in the gold market. People buy when things look really good, and people will sell when things look really bad. And this event, I'm not saying this is going to be a major crash. This will probably be a blip like every other blip, but we just don't know. We don't know what will happen. But the issue is we have to hold through the time when we don't feel good to be able to get the returns that we want. So if every time that you buy when everything seems clear, if you sell when everything seems terrible, you're going to get the returns of these average investors, 2.5%, just by investing and being a true investor and getting through these periods when things seem bad. You can feel emotionally bad. I mean, that's what Jason Zweig says, that you're going to feel emotionally bad. But if you sell during these time periods, you will truly lose the loser's game. You will get these types of average returns. We don't want to be average. We want to be at least get the returns of our investments. So let's talk about Brexit. So with the United Kingdom, this was as of 2014, but 15 was very similar. The United Kingdom has 7% of all the world equities are inside the United Kingdom. Now, I understand all the the fear mongering that's going on with Europe. I understand that. But no one really knows what's going to happen with this Brexit. No one knows, no one knows all the things that could conspire to happen. But what we do know is that Britain makes a lot of goods and services. They have a lot of banking. They are a very important part of the world. If you need a loan today, would you not go still to a bank? Will Britain still not loan people money? Will Britain still not be making, I worked for a pharmaceutical company that was in the UK. Will GlaxoSmithKline, AstraZeneca not be making medicine? Will people still not need cough medicine, other types of nicotine patches to quit smoking? I mean, all of these products that the United Kingdom produces, in the very short term, yes, there could be trade tariffs and other issues, but in the longer term, won't people continue to use the products that they love to use? I think they will. And Charlie made this point this morning that we invest in companies, and leading edge financial planning's belief is do not invest in individual companies. Individual companies can and do go bankrupt. Invest in markets. Do not even invest in individual countries. And anyone that just invests all their money in the United States, this kind of thing could happen to the U.S. someday. I know we don't think it's going to happen. I don't think it's going to happen. But yesterday, as we were in watching the markets yesterday, we did not expect for Brexit to happen. I mean, the market said that it wasn't going to happen. Markets were up big time yesterday with the thought that it wasn't going to happen. Now, some people might have guessed it. But anyway, when we come back to the fact that the world is interconnected, that people in Germany and France will still want to buy goods from the United Kingdom. United Kingdom will want to buy goods from the U.S. and other countries, emerging market. If you're diversified across the world, which is what we believe, own the whole world, and if you have 8 to 10 to 12,000 companies and markets do go down, yes, we will cry together, but knowing that investments, we expect stocks and markets to go up and down. We just have to say that we expect this kind of thing. And although it's painful, this is a part of investing. So, what would Warren Buffett do today? What would Jack Bogle do today? What would William Bernstein and other people that we follow do today? They would probably just stay the course. That's the reason why Warren Buffett has gone from a mildly wealthy person to the most extraordinary wealthy person, is that he has stayed the course throughout his investing career. And in the short-term time periods when markets go down, we have to be patient. I'm just going to show you one more slide and then I'll end this. And I know my picture is kind of, the video is kind of covering up part of this, but I assure you the last 10 years have been the same as other years. And this just shows that really expectations of 10, 20% drops, if you don't have those expectations, then you hadn't been paying attention to history, and we've not done a good enough job to share with you that markets are volatile. There's times when there's quiet and there's times when there's markets go down, but the blue here is where markets finished at the end of the year. The downward red is how low it went during that year. And let's see if I can move my picture up here. In 2008, we had a downward of 50%. And so these things are expected. But don't get too discouraged. I mean, that's the key. Optimism is the key to investing. And although the news continues to change, there's a different, Greece on fire, Brexit. We've invested. Not we personally, but our parents and their parents invested through the Great Depression, 2 world wars. We invested during Vietnam. We invested during all these other issues that I showed you from the 1970s on, and there will be other events. So do not get too discouraged. And finally, understand that the beast, we don't want to feed the beast. The beast is our emotions, and this is all a part of investing. Happens every time. When markets go down, we get nervous. Now, I'm not suggesting markets will go down, but go for a walk, spend time with family. If people talk about investing or talk about world politics. Don't get involved in those discussions. Enjoy your life. That's the reason why we invest our money, to enjoy a better future. So thanks for watching. I'm Kevin from Leading Edge Financial Planning. Have a great day.